Welcome back to Investing Talk Podcast.
Today we're looking at Unity software.
As usual, before we start, subscribe, like, and comment to this video to support the show. I mean, we really have a situation unfolding right now that feels like a classic textbook turnaround playing out in real time.
Oh, absolutely. Really is.
And, if you play mobile games or really engage with any interactive digital content, you are already interacting with Unity.
Right. You're in their ecosystem whether you know it or not.
Exactly. But the narrative on Wall Street has shifted dramatically. What is making this company the absolute center of attention right now isn't just about the software used to make the games. It's about how they are bridging this massive gap between game creation and AI-driven monetization.
Yeah, that's the real story.
They are essentially building an unavoidable toll booth right in the middle of the digital economy. And the adoption numbers we are seeing suggest they've dug a competitive moat that is going to be incredibly difficult for anyone else to cross.
The historical context here is critical because for a long time, the narrative around this company was just incredibly fractured.
No, totally.
I mean, they were universally loved by developers for their creation tools, the actual engine used to build the digital worlds.
Right. Developers swear by it.
But they notoriously struggled to fully capitalize on the business side. They just couldn't figure out the monetization. What you are seeing right now is the aggressive convergence of those two halves.
Okay, so bringing the creation and the money together.
Exactly. They are executing on a vision where the engine that builds the game is seamlessly, tightly integrated with the artificial intelligence that serves the ads and drives the revenue.
Right.
For you as an investor, you have to stop looking at this as just a video game play.
Right.
This is a highly scalable, AI-powered advertising infrastructure play, wrapped completely inside a ubiquitous software ecosystem.
Okay, let's unpack the fundamentals here and really check the math on this turnaround, because the numbers coming out of the Q4 2025 report are telling a very specific story of acceleration.
Yeah, the data is fascinating.
So they beat expectations, bringing in $503.1 million in revenue for the quarter. But to actually understand the mechanics of the business, we have to slice that revenue into their two main segments, right? Create solutions and grow solutions.
Right, the two pillars.
So create solutions, which is the side where developers actually build the content, hit $165 million. That is an 8% increase compared to last year, largely driven by incredibly sticky subscription growth.
Very sticky.
And then you have the bigger piece of the pie, grow solutions, which is the monetization side. That hit $338 million, up 11% compared to last year.
Right.
But I have to be honest, though, looking at those top-line numbers, 8% and 11% growth, that doesn't scream explosive tech stock to me. It sounds stable, but it doesn't sound revolutionary. What am I missing here?
You're missing the engine inside the grow segment.
Okay.
Looking at the blended 11% growth is like looking at a car's average speed while ignoring that someone just strapped a rocket to the chassis.
Okay, what's the rocket?
The fundamental takeaway for anyone looking at this company today is Unity Vector. This is their AI-powered ad platform. It currently accounts for 56% of that entire grow segment.
Over half. Okay.
Over half. And the trajectory is what Wall Street is suddenly waking up to. In January 2026, Vector's revenues didn't grow by 11%. They surged 72% compared to the prior year.
Wait, 72%?
72%.
For a platform operating at this scale, I mean, that is a massive acceleration.
Yeah.
But how? The mobile ad space is incredibly crowded and competitive right now. How does an ad platform suddenly pull a 72% growth lever out of nowhere?
By completely changing how the ads are served. Historically, the company was dealing with legacy systems, specifically their acquisition of the ironSource ad network a while back.
Right. I remember that acquisition.
Yeah, and ironSource was essentially a digital billboard company. It just placed ads in front of eyeballs, hoping someone would click.
Throwing spaghetti at the wall.
Exactly. Vector is an entirely different beast. It uses predictive artificial intelligence to analyze player behavior. It doesn't just show an ad, it figures out precisely which player is most likely to click and spend money, and serves the right ad at the exact right millisecond.
So it's highly targeted.
Highly targeted. It's the difference between putting up a billboard on a highway and having a hyper-targeted salesperson who knows exactly what the driver wants to buy.
Wow, okay.
And when a developer sees that the Vector AI is giving them a massively higher return on their ad spend, they move their entire budget over. When you prove to a developer that your platform makes them more money, they do not leave.
Make the money and they stay, right?
Exactly. And that's why we are seeing mid-teens sequential growth for 3 straight quarters now. They are aggressively stealing market share.
And it seems like that operational leverage is finally showing up where it actually counts, right? The margins.
Hmm.
In the software sector right now, we usually see growth coming at the heavy expense of profitability.
Oh, almost always.
But in Q4 2025, their adjusted EBITDA margins expanded to 25%. That is a 200 basis point expansion compared to last year. And management isn't stopping there. They are actively guiding for another 300 basis point expansion in Q1 of 2026.
Which is huge.
It is. When we look at the bottom line, current EPS estimates are sitting at 20 cents for the quarter, which is up a staggering 166.7% year over year.
Yeah.
And 82 cents for fiscal year 2026, up nearly 149%. The top-line forecasts show $1.84 billion for the current fiscal year, accelerating to $2.09 billion next year.
Right.
How are they managing to expand margins by hundreds of basis points while completely overhauling their AI infrastructure? Because usually an AI pivot burns an insane amount of cash.
Yeah, that margin expansion is a direct result of the structural, painful changes they've made to their financial health over the last year. Let's go back to that legacy baggage, the iron source network. It was dragging down their efficiency. But today, that legacy network is down to under 6% of their revenue.
Wow, so they basically phased it out.
Effectively, yes. They migrated their entire ecosystem over to the high-margin Vector platform. But the really crucial part of the margin story is their capital allocation strategy.
Meaning what they do with the cash.
Right. They are not paying dividends. They are not aggressively buying back stock just to artificially inflate their earnings per share to please impatient investors.
Thank goodness.
Instead, they are taking this improving free cash flow, which is being driven by projected operating margins of nearly 26%, and they are aggressively reinvesting it back into the business. They are funding new AI tools, runtime data integration, and platform expansion.
Which naturally brings us to the moat. In software, if you don't have high switching costs, somebody cheaper or faster will eventually eat your lunch.
100%.
So I want to talk about Unity 6, their newest engine iteration. The data here is wild. It shows a staggering 90% adoption rate among active creators.
It's massive.
90%. They are migrating to Unity 6 faster than any prior version in the company's history. Why is that specific metric so important?
It's a phenomenal metric because upgrading a game engine is notoriously painful. If you talk to developers, they will tell you that migrating to a new engine mid-project can break code, it can ruin physics systems, it can cause massive delays. It is a total headache.
Oh, they don't do it lightly.
Never. If 90% of creators are willingly making that jump despite the friction, it tells us that the new features in Unity 6, specifically the AI integrations and the performance upgrades, are absolute necessities. It creates an incredibly deep competitive moat built on network effects.
Right.
The core philosophy of this company has always been build once, deploy anywhere. A developer can build a game and with incredible ease export it to an iPhone, an Android device, an Xbox, or even a WeChat mini game in China.
That's huge.
That interoperability is a superpower for a small indie studio, and it is exactly why they are protected from their main competitor, Epic's Unreal Engine.
Right, because Unreal is the other massive player in the room. Everyone knows Unreal.
Exactly. But they serve different masters. Unreal is fantastic for those massive, high-end AAA console games that take 5 years and $200 million to build.
Like the big blockbuster titles.
Yeah. But Unity owns the vast, sprawling, infinitely larger universe of mobile, casual, and cross-platform development. By controlling that foundational creation layer with Unity 6, and now controlling the monetization layer with the Vector AI, they have locked down the entire life cycle of digital content.
Okay, so let's pivot to the charts. Because if the fundamentals are turning around, the AI platform is accelerating, and the moat is intact, is Wall Street actually buying it?
Right. Let's look at the price action.
Yeah, let's take these operational metrics and see how they are manifesting. Because looking at the broader software sector right now, it has been an absolute bloodbath.
Brutal.
Yet we've seen some very distinct bullish momentum here lately. Over the past week, shares climbed 8.9%, pushing up to $19.85. And then on March 4th, 2026, we saw a sudden 6% jump, well, 6.09% to be exact, pushing the stock over the $20 mark to settle at $20.02.
Right.
Now, I know a 6% move might not sound earth-shattering in the highly volatile world of tech stocks, but Context is everything.
Context is everything. A 6% jump is nice, but let's not pop the champagne just for the percentage points. The reality is that jump happened during what was broadly described across trading desks as a bloody market.
It was deep red everywhere.
The broader indices were deep red. The software sector specifically was facing heavy, relentless selling pressure. And yet, amidst all that red, here's this stock jumping 6% on high relative volume.
What does that tell you?
What that signals to a technical analyst or a quantitative hedge fund is massive relative strength. When a stock completely ignores a sector-wide sell-off and marches higher on heavy volume, it means institutional buyers are stepping in. They aren't just holding, they are buying the dip aggressively.
And it sets up a really fascinating technical scenario on the chart. That $20 level isn't just a random number, it is a massive psychological resistance point.
Oh yeah, huge battleground.
It's a clean, round number, and it has historically been a major battleground between buyers and sellers. When investors start accumulating flow and physically pushing the price through that $20 resistance level, especially during a broader market downturn, it usually means smart money is positioning themselves ahead of something big.
They're getting in early.
Exactly. They are front-running the narrative before the retail crowd catches on.
When you see a stock print higher highs and higher lows against the violent grain of the broader market, you are looking at a structural breakout. The accumulation we are seeing heavily suggests that funds are building their core positions before the broader market fully digests the margin expansion story we just talked about.
Right.
The institutions see the 72% vector growth numbers, they see the 300 basis point margin guidance, and they're locking in their cost basis right here at the $20 threshold.
Which naturally leads us to move into the sentiment and catalysts. Who is actually driving this institutional flow? It didn't just appear out of thin air.
No, it didn't.
The mood around this stock has been shifting from highly mixed to decidedly positive, and that recent jump over $20 was highly catalyzed by a major player on Wall Street completely changing their tune. Bank of America officially upgraded them from underperform to neutral.
That is a highly critical upgrade to understand.
Why is that so important?
Because on Wall Street, an underperform rating is essentially an analyst's polite, professional way of saying, sell this immediately.
Right, get out now.
Exactly. So when a major institution with the weight of Bank of America completely abandons their bearish thesis and upgrades to neutral, it causes a chain reaction. It forces a massive amount of algorithmic trading models to automatically adjust their weightings and buy the stock.
Algorithmic buying pressure.
Yes. It also forces short sellers to reconsider their downside positions, which creates a short covering squeeze that adds to the buying pressure. The analyst community as a whole is signaling that the fundamental bottom is officially in. If you look at the broader consensus right now, average price targets are sitting right around $31 to $35.30.
I'm doing the math on that. And a $35 target implies a massive 76% upside from where the stock is currently trading in the $20 range.
Huge upside.
And the highest target on the street is sitting all the way up at $56. So the quantitative sentiment is clearly tilting bullish. But targets are just numbers on a spreadsheet. What's going to actually bridge the gap between a $20 reality and a $35 expectation? Let's look at the catalyst calendar for the next 3 months.
This is where it gets exciting.
The big one happening right now in March 2026 is GDC, the Game Developers Conference.
GDC is the absolute Super Bowl for this industry.
Oh, yeah.
It is where the technological roadmap for the next 2 to 3 years gets laid out in front of the entire developer ecosystem. And the speculation on the floor right now is entirely focused on unconfirmed reveals that could dramatically alter the revenue modeling for the company. We are specifically looking for announcements around runtime data for ad targeting.
Okay, let's clarify that for a second. When you say runtime data, you mean telemetry. Tracking how a player is behaving inside the game in real time.
Precisely. If they can process in-game telemetry data in real time, knowing exactly where a player is stuck, what they are clicking on, how frustrated they are, and use that to serve hyper-targeted ads, the return on ad spend for developers goes through the roof.
Because they know exactly when to hit the player with the ad.
Exactly. Which in turn means the Vector platform can charge a massive premium. Beyond that, we are also anticipating major reveals around their generative AI creation tools, new browser-based authoring environments, and native in-app purchasing frameworks slated for rollout in Q2 2026.
Lots of moving parts.
If management nails these presentations at GDC, it completely cements the narrative that they are the undisputed infrastructure layer for the future of interactive media.
And right on the heels of GDC, we have the Q1 earnings report coming up in early May 2026. This is the put up or shut up moment.
It really is.
This is where management will have to mathematically prove that the 300 basis point margin expansion they promise is actually materializing. But it's not just company-specific catalysts we have to watch. There are massive macro tailwinds at play here, too.
Huge macro tailwinds.
The data shows 10 to 15% year-over-year growth returning to the mobile gaming sector. Ad spend is finally rising globally after a brutal contraction. We're also seeing a broader sector rotation into a SaaS recovery. And crucially, if the central banks initiate potential rate cuts later this year, it acts as a massive valuation tailwind for growth-oriented software stocks like Unity.
The macro environment is finally setting up perfectly for them. You have to remember, during the recent economic tightening cycle, developers slashed their budgets out of fear, and marketing ad spend completely dried up.
Yeah.
That is what caused the agonizing pain in this stock over the last 2 years. But with mobile gaming growing at 15% again, the overall pie is expanding rapidly. And if you are the toll booth operator connecting the creators to the advertisers, your revenue floor naturally rises with the rising tide of the entire industry.
Okay, I want to hit the brakes here.
Sure.
We've built a very rosy picture, but let's look at the flip side and build the bear case. As analytical investors, we cannot ignore the red flags, and I am seeing a couple of glaring ones.
Fair enough. Let's hear them.
First of all, let's talk about that Q1 fiscal 2026 guidance. Management guided for revenue between $480 and $490 million. Now, that is below the consensus estimate of $491 million. It's a miss on the forecast.
It is slightly below, yes.
And couple that cautious guidance with the fact that we saw notable insider sales right after the Q4 earnings gate. I have to ask, if the turnaround is going so perfectly and Vector is growing at 72%, why is management guiding lower than the street wants, and why are insiders taking chips off the table? That feels like a massive warning sign that can heavily pressure near-term sentiment.
Look, it looks bad on a headline, absolutely. Cautious guidance often gives momentum traders an immediate excuse to lock in profits, and insider selling never inspires confidence when you're trying to build a recovery narrative.
Exactly.
However, as a growth analyst, you have to look past the headline and at the actual mechanics of what's happening. Let's take the insider selling first.
Okay.
Executive compensation in tech is overwhelmingly equity-based. The insider sales you're seeing are almost always pre-planned 10b5-1 programs.
Yeah.
These are automated, legally binding sell-offs set up months, sometimes years, in advance.
So it's not a panic sell.
No, not at all. They are executed automatically for tax purposes or basic portfolio diversification. It is a mechanical tax event, not a signal that executives are secretly jumping ship.
Got it. And the guidance.
Regarding the conservative guidance, you have to understand the psychology of a turnaround. A new management team executing a recovery will almost always intentionally lower the bar. They want to set a target. They know for a fact they can step comfortably over next quarter. It's expectation management 101.
Sandbagging the numbers, basically.
Yeah. Fair enough on the internal mechanics, but what about the broader macro and competitive threats? We noted earlier that the software sector as a whole is down 21% over the last 6 months.
True.
Software has been a brutal, unforgiving place to park capital. And more importantly, let's talk about the AI elephant in the room. Google's Project Genie.
I knew we'd get to this. We have to. Google is actively developing incredibly powerful generative AI models that can theoretically conjure playable, interactive game environments from simple text or image prompts. Doesn't that directly, fundamentally threaten the core creation tools we've been talking about? If a developer can just prompt Google to build a level in 10 seconds, why on earth do they need Unity 6? Doesn't the mode evaporate?
This is the most common bear argument right now, and honestly, it fundamentally misunderstands the brutal complexity of game development.
How so?
Google's Project Genie and similar generative AI models are undeniably incredible at generating assets. They can make a beautiful 2D background, they can generate a character sprite, they can maybe even string together a basic platforming mechanic.
Right.
But a commercially viable game is not just a collection of pretty assets. It is a highly complex, deeply integrated ecosystem. You are dealing with advanced physics engines, dynamic lighting systems, strict memory management, cross-platform user interface frameworks, and critically, the monetization and deployment pipelines.
So it's not just a magic button.
Far from it. You cannot just type make me the next hit mobile game into a prompt box and have it spit out a compiled, perfectly optimized application that runs identically well on a 4-year-old Android phone and a brand new iPad, while simultaneously managing real-time ad bidding on the back end.
So you're saying the threat of generative AI replacing the engine is completely overstated?
I'm saying the risks appear entirely heavily priced in at this $19 to $20 level.
Yeah.
The broader market has spent the last 6 months violently punishing software, which is exactly why we saw that 21% sector drawdown you mentioned.
Right.
But at a certain point, the underlying valuation becomes a concrete floor. The massive 72% explosive growth in the vector ad platform, combined with the influx of institutional upgrades, provides a heavy, tangible offset to the speculative, futuristic fears around Google's AI. The moat isn't just making the art. The real moat is the operational infrastructure of running the digital content as a highly profitable live business.
Okay, let's synthesize this and put it all together. Time for the final verdict.
Let's do it.
Based on everything we've unpacked today, the accelerating fundamental metrics, the bullish technical breakouts against a bloody market, the shifting institutional sentiment, and the very real but likely priced-in competitive risks, the official bullish score for Unity software comes in at an 8 out of 10.
It is a high score, and looking at the data, it's well-deserved. The elevator pitch for this company right now is incredibly compelling for anyone paying attention.
Summarize it for us.
You have a newly focused management team executing a highly successful textbook turnaround. The absolute explosion of the vector ad platform, again, growing at 72% year over year, combined with the unprecedented 90% adoption rate of Unity 6, is driving real, measurable revenue acceleration and expanding their operating margins by hundreds of basis points.
They're fixing the engine while flying the plane.
And doing it well. They have successfully positioned themselves to own the entire bridge between the creation of digital content and the actual monetization of it.
So how should you be looking at this in terms of a target horizon? From a purely tactical perspective, it is highly viable as a 1 to 3 month swing trade.
Definitely.
You have the institutional momentum pushing the price past that critical $20 resistance level. You have the GDC roadmap reveals happening right now to drive the narrative, and you have the Q1 earnings report acting as a major catalyst in early May.
Right. Lots of near-term catalysts.
But fundamentally, the real value here is positioned as a multi-year hold. If you believe that artificial intelligence is going to exponentially increase the sheer volume of digital content being created over the next decade, then the infrastructure platforms that host, deploy, and monetize that tsunami of content are going to be the ultimate long-term winners.
They are essentially selling the picks and shovels for the AI-driven digital content gold rush.
Exactly. And I want to leave you with a final provocative thought to mull over as you look at this sector. We just debated how AI, like Google Genie, is generating game assets faster and cheaper than ever before. But think about the economic consequence of that.
It's profound.
What happens when the actual cost of creating a game drops to near zero? We are going to see a flood of content hit the app stores unlike anything in human history. Millions of games.
A total saturation of content.
Right. And in a world where absolutely anyone can create a polished game in a single afternoon, the actual game itself loses its premium value. The true scarcity, and therefore the true immense value, will be the attention of the player and the technological ability to efficiently monetize that fleeting attention.
That's a great point.
As the developer ecosystem becomes infinitely, overwhelmingly crowded, the power permanently shifts away from the creators and directly to the ad networks and the data engines that can successfully connect a player to a game. Unity is sitting right at the center of that hourglass, controlling the flow. Subscribe, like, and comment to this video to support the show.